How to become a better investor, 7 habits that matter more than stock tips. Most investors do not become better by finding more stock tips. They become better by making fewer avoidable mistakes. That may sound less exciting than discovering the next big winner early. But over a lifetime of investing, your results are often shaped less by brilliance and more by behavior. Panic selling during market crashes. Chasing hype near the top. Constantly switching strategies. Buying businesses you do not understand. Interrupting compounding because you got impatient. These are the habits that quietly damage long-term returns. Quick answer. How do you become a better investor? You become a better investor by improving your decision-making. That means understanding the businesses you own, writing down why you bought them, learning from mistakes, staying calm during market volatility, giving compounding enough time to work, and following a simple investing system you can stick with. 1. How do you stop chasing stock tips? You stop chasing stock tips by accepting that excitement is not the same as opportunity. There will always be a new theme dominating the market. Artificial intelligence, electric vehicles, meme stocks, cryptocurrencies, or whatever comes next. Some of these trends will produce excellent long-term businesses. Many will not. The danger is not curiosity. The danger is feeling pressured to buy simply because everyone else seems to be making money. Meanwhile, some of the strongest long-term investments may look boring on the surface. A bank such as DBS Group Holdings Limited SGX, D05, or a supermarket operator such as Shangxiang Group Limited SGX, OV8 may not dominate social media conversations. But businesses that steadily grow earnings, cash flow, and dividends over time can still reward patient shareholders. Better investors spend less time asking, "What is hot now?" They spend more time asking, "Is this a good business I can own for years?" 2. What should you look for in a good business? A good business should be able to grow, generate cash, manage debt, and remain competitive over time. Many beginner investors focus too much on the share price. But a stock represents ownership in a real company. That company needs to serve customers, manage costs, invest for growth, and survive difficult periods. You do not need to become an accountant to invest well. But it helps to ask a few basic questions. Is revenue growing? Are profits sustainable? Does the company generate healthy cash flow? Is debt manageable? Can dividends continue to grow? Does the business have an advantage over competitors? This is especially important for income investors. Many investors buy rates because the dividend yield looks attractive. But a better investor will also ask, are occupancy rates healthy? Can rental income continue growing? Is the balance sheet strong? Could higher interest costs affect distributions? The more you understand the business, the less likely you are to panic over every share price movement. 3. Why should you write down your investment thesis? A good practice is to write down or note down your investment thesis because it forces you to be clear about why you are buying a stock. Before buying a stock, you should be able to answer the following questions. Why am I buying this company? What do I expect the business to achieve? What are the main risks the company is facing? What would prove me wrong? When would I consider selling? This helps you separate a real investment decision from an emotional impulse. Without a thesis, it is easy to rewrite history in your own mind. A short-term trade becomes a long-term investment. A stock tip becomes a high-conviction idea. Writing things down keeps you honest. It also helps you tell the difference between temporary market volatility and actual business deterioration. 4. How do good investors learn from mistakes? Good investors learn from mistakes by reviewing what went wrong without letting ego get in the way. Every investor makes mistakes. Some buy too late. Some sell too early. Some overpay for a good company. Some buy a poor business because the dividend yield looked tempting. The mistake itself is not always the biggest problem. The bigger problem is refusing to learn from it. A useful question to ask is, was this a bad outcome or was it a bad decision? Sometimes a good decision can still lead to a poor short-term result because markets are unpredictable. Other times, a profit can hide a weak decision that only worked because the market was forgiving. Better investors review their decisions over time. This is how judgment improves. 5. How can you avoid panic selling? You avoid panic selling by knowing what you own before the market falls. It is easy to say you are a long-term investor when markets are rising. It is much harder when your portfolio is down, headlines are negative, and everyone seems worried. This is why emotional discipline matters so much. Market volatility is uncomfortable, but it is not unusual. Even strong businesses experience periods when their stock prices decline. The question is whether the business itself has changed. If the company's fundamentals remain intact, a lower share price may not be a reason to sell. It may simply reflect short-term fear. But if the business has weakened, debt has become unmanageable, or the original investment thesis no longer holds, selling may be the right decision. Better investors do not blindly hold forever. They learn to respond to facts, not fear. 6. Why does compounding need time? Compounding needs time because the early results often look small. At the start, dividends may feel modest. Capital gains may feel slow. Business growth may not look dramatic from one quarter to the next. But over many years, small gains can build on one another. A company that steadily grows earnings and dividends can create meaningful shareholder value over time. Reinvested dividends can buy more shares. Those shares can generate more dividends. Gradually, the effect becomes more powerful. The challenge is that modern investing culture encourages impatience. Investors are constantly comparing returns, checking prices, and wondering whether they should switch to something faster. But compounding does not work well when it is constantly interrupted. 7. What investing system should beginners follow? Beginners should follow a simple investing system that helps them stay consistent. It can include setting aside money regularly, building a watch list of quality companies, diversifying sensibly, reviewing your portfolio periodically, and avoiding impulsive decisions based on headlines. Some investors may invest monthly. Others may wait for attractive valuations. Some may focus on dividend stocks. Others may combine dividend stocks with growth companies. The exact approach can differ. What matters is whether the system is sensible, repeatable, and suited to your temperament. A boring system you can follow for 20 years is often more valuable than an exciting strategy you abandon after 2 market downturns. Frequently asked questions about becoming a better investor: what is the most important skill in investing? The most important skill in investing is emotional discipline. Investors need to stay rational when markets rise quickly and when they fall sharply. How can beginners get better at investing? Beginners can improve by learning basic business fundamentals, starting with simple investments, writing down why they buy each stock, and reviewing their decisions over time. Do you need to be good at maths to be a good investor? No. Basic numeracy helps, but investing success depends more on judgment, patience, consistency, and the ability to understand businesses. How long does it take to become a better investor? Investing is a long-term skill. Most people improve gradually as they experience different market cycles, make mistakes, and learn how they behave during periods of fear and greed. Get smart. The bottom line: becoming a better investor is usually less about finding perfect stocks and more about building better habits. The investors who succeed over decades are often not the ones making the boldest predictions. They are usually the ones who stay patient, continue learning, avoid emotional decisions, and allow compounding to do its work over time. In investing, small good decisions repeated consistently often matter far more than occasional moments of brilliance.